Do you know that the private property index went up by 2.5% in 2019 and year before it did 7.9% growth? So right now you have some money inside your CPF and you're thinking, should you buy a property? Should you get it invested into it somehow? And today we're answering this question. Is your CPF money better off buying a property? Break this question in two parts. How does the growth of the property index run versus 2.5% CPFOA interest rate? Now that directly answers the question, and today I'll give you some data points so that you understand factual information. Now again, I'd like to invite you to smash on the subscribe button below because we'll be launching videos every week that touches on such useful information, and join our community to become more financially savvy. And the second part of the discussion today is focusing on prospects of the property market moving from 2020 onwards. I have some very interesting information that I'd like to share with you. I'll put a quick chart for you to see over here. This graph illustrates to you the importance of knowing how the property market has ran up in terms of phases. In this phase from 2012 all the way to today, you realize that the growth is actually quite moderate. It's done on average 2.5%, which means you're not better off moving your CPF monies into a physical property itself. Now again, what that means also is any investor that bought from 2013, 2014 most likely underperformed 2.5% of the CPFOA interest rate. And that conversely, that also means for any investor that have actually invested from 2005 to 2012, they have actually done much better than the 2.5% of CPFOA interest rate. Now, this part over here is very important to focus. Property moves in cycles, and in this cycle from 2005 to 2012, you realize that the index actually gained a whopping 160%. That also translates to 20% year-on-year growth. That is a huge rate, and it was clearly unsustainable. And most of the fancy, sexy stories of property windfall gains actually come from people who bought properties in this phase, 2005 to 2012. These homeowners, these property investors made tremendous amounts of money, and that did not actually translate to anybody who bought a property from 2012 onwards. I have an interesting finding to show you over here. This illustrates to you that property price actually moves in very slow cycles. Imagine this, if you saw the Asian financial crisis in 1997 and you waited for property prices to drop by 20%, in June 1998 you entered the market thinking that you bought things on the cheap, what would have happened, or what it needed for you to wait to beat this 2.5% is actually a whopping 9 years. How does it actually go? You have to follow this slow property market recovery, and it's only in 2007 did the prices actually recover significantly to let you beat 2.5% per annum in terms of rates. Now this doesn't even factor in stamp duties, maintenance charges, etc, etc. This is just purely looking at a growth of 2.5%. You have to wait for 9 years for a market to fully recover and get to the next up leg of the market cycle. So if you're a homeowner, there's no guarantee that your monies are better off inside the property than inside CPFOA, which gives you 2.5%. Again, the phase that you buy, the market cycle that you buy strongly determines your rate of return, and you must wait sufficiently long for a few market cycles to really see this outperformance over 2.5%. So in the short to medium term, there's no guarantee that you'll do better. And again, there's another factor to consider. If you're an investor, you get rental income, you're not staying inside it. And when it comes to rental income, it makes the equation a lot better because that adds on to your yield. Yield is how much income you derive from the total purchase. But when it comes to rental income also, there's a few points to consider. That increases your property taxes, that increases your personal income taxes, and that has further maintenance costs for you to consider on. And again, if you are looking to be an investor, I strongly consider you watch this video that I've previously done. How does property rental income compare against dividend income? Because that video addresses the differences, and I'll leave links below for you to understand them. And in addition, finding tenants is not a guarantee. Some property owners, some property investors actually go 6 to 12 months without rental income because there's just no tenant. The competition is just too stiff. And again, when it comes to property investing, the real gains are actually when property markets move tremendously in the 2005 to 2012 phase. Missing out on that phase means you miss out on a lot of the gains. Missing out on a phase means you actually are not going to see the real fruits of investing in property, which leads to the next point. What is the prospects of the property market moving from 2020 onwards? The bulls are going to say, do you know that Urban Land Institute and PwC issued a statement that Singapore is the top property place to be in because they have some basis. They are not idiots. They are definitely going to have a basis to rank Singapore first, and that Singapore's economy has to be looking good. The bulls also say, do you know that Donnie Yen is rumored to be interested in Singapore property because Hong Kong is in such a mess? Imagine this, all the high net worth individuals around the region are just going to park their monies into Singapore property. Of course, that's going to pull up the index. Of course, that's going to benefit the overall sentiment. The bulls also said, do you know Nas Daily? Even he is interested in setting up a business in Singapore. Of course, the prospects here is good. On the other hand, the bears will say that, do you know that there's more than 50,000 units going to be launched? And do you know that each year, only about 10,000 units or so? How many years is it going to sell out this 50,000 units? That many years. The bears will also say, look at this population growth chart over here. How many years is it going to take to sell? Because there's just not that many new residents in Singapore. It's going to take so many years, and that with this oversupply, prices are just not going to go up. In fact, it might just come down crashing. So again, leave in the comment sections below. Do you think the bulls or the bears have a better case? If you have benefited from this discussion also, smash the like button below so that more people can see this useful information, more people can see these useful data points and make savvy decisions. With that, I'll thank you. I would like to sign off from here. See you in a future video. Goodbye.